Hello Sector Watchers, this is the 45th episode of Sector Spotlight on Tuesday the 25th of August, recorded on the 24th. Welcome to the show, my name is Julius de Kempenaer and as usual I am your host for today's show. After our regular look back at what happened during last week's trading, I'm going to work my way through the investment pyramid from the top down using a lot of RRGs trying to make sense of the bigger picture. I was reminded of the importance of a high-level overview last week, as I had rented a lift to do some work at heights here at the farm. It's amazing how different the world looks when you rise above it. It was very cool and, yes, I admit, sometimes a bit scary, but the different perspective that you get from that elevated level definitely adds value and helps you paint the bigger picture. And that is exactly how I see relative rotation graphs. They are a tool that helps you get a different perspective on what's happening in markets from a high-level overview. After the break, we'll break down the technology sector into industries and put those on an RRG to analyze the dominance of the technology, hardware and storage group and the dominance of Apple inside that group. There's no time to waste. Here we go. So here are the RRGs for asset classes and sectors side by side, as we usually show them here on Sector Spotlight. To get a glimpse, get a handle on what happened in the last trading week. And that was the week ending on August the 21st, Friday, August 21st. If we start on the asset classes, it's still a biased picture with stocks inside leading, the US dollar inside improving, but far to the left. It's actually the weakest asset class if you scale on the RS ratio axis. Commodities, DJP is the only one inside the weakening quadrant, and let me add our GSG group there to make this look a little bit better. So GSG went up, commodities there went down, so there's still a big difference between those two groups of commodities. And now we got the fixed income stuff inside lagging, including real estate. If we look at the percentage change, and we see that our benchmark gained 0.5% and stocks did 0.6 and government bonds did 0.4, so not a lot of difference there. Overall, the balanced index portfolio went up around 0.5%, which is pretty good for a week. And we have some outliers on the upside and the downside. There's the Bloomberg Commodity Index gaining almost 1%. Got high yield corporate bonds and investment grade corporate bonds doing pretty well on performance wise, but they're still inside the lagging quadrant. And we have real estate V&Q making this rotation into the lagging quadrant, so that's not looking very good. And then we've got these we already discussed. The US dollar inside improving, not a strong week, not much happened, but it remains the weakest asset class if you want to, label the US dollar as an asset class, as the weakest on the RS ratio scale. If we move over to the stock market, to the sectors, we rank this one on percent change. We see that the SPY gained 0.8% in line with ITOT. And there's only a handful of sectors that have been outperforming last week. So I think we can call these the usual suspects. They're technology, consumer discretionary, and communication services. So that's Apple and Amazon, leading the market again. And we see the tail on industrials. It started pretty good last week. If we go back last week, if you remember that, 1, 2, 3, 4, 5, this was the tail for industrial, so that looked pretty good. Extended a little bit, and then at the end of the week it rolled over and eventually lost, what was it? Well, again, 0.9%. Sorry, industrials. So minus 1.4, and then today is the 24th. Industrials is back up there with 0.9%. So you can see how quick those changes can go when you work with a daily RRG. Anyway, the usual suspects over there, and then we've got a handful or a big group actually inside the lagging quadrant. With real estate, obviously there, it's in line with what happened on the asset class side. Energy, really bad tail, confirming its longer term weak picture. Financials actually breaking to new relative lows, which I don't think looks very good. Same for utilities, that's also a very weak sector. It's a defensive sector, breaking to new lows. We could argue that that's good for the stock market. And then we got materials rolling back over, healthcare. They're inside lagging, not very clear. They're gaining on the momentum scale, but losing slightly on the relative strength scale. So we need to move to a longer term picture to get a better handle on those. And that's exactly what I want to do now. My idea is actually to look at a lot of RRGs in this episode and work our way through the investment pyramid as we've been maintaining it here on Sector Spotlight. Now let's move to let me move to the asset allocation and stick with the weekly. So we got a little bit longer term picture because this investment pyramid looks at a little bit longer term ideas or I don't know, whatever you want to call it. Let's just work our way from left to right. Real estate, we already said that was a weak asset class, and that's confirmed here. And you see that it is inside improving on the weekly RRG, but rolling over. So we're going to stick with a red box there, which means underperform. Government bonds and stocks, I actually changed. I was like sort of neutral on those because there was not a really clear message. I think I have to decide now that stocks continue to beat government bonds, so that little period of neutral view has shifted once again in favor of stocks. And you can see also that there's this little hiccup here. You see that government bonds now have started to shift further to the left, where stocks actually, if we zoom in a little bit here, we see it a little bit better, started picking up again. So it makes sense to give the benefit of the doubt to the stock market with those tails, especially if they start to pick up momentum in the case of stocks and lose momentum in the case of government bonds. If I look at the main reason to actually to make that move is what happened on the government bond chart. We discussed that nice little flag-like pattern, which you couldn't call a flag because it was too long-winded. And I think the market is proving why it is not a flag, because it couldn't go past this resistance level. And this is now, you see we've got this drop. We got 1 week up, and now we already started to, you can see sort of getting weakness coming in again. The relative strength is weakening again. With a little fantasy, you could see this turning into a double top, which would be really negative for bonds and lead to higher yields. So the comparison between stocks and bond is now, I think, definitely back in favor of stocks. So the hesitation looks like it's gone now. So stocks back to outperform, bonds to underperform. We're going to stick with a underperform for high yield. Let me show them here. Underperform for high yield, underperform for commodity, and underperform for corporate bonds. Corporate bonds did well, and they are now also back into the lagging quadrant. So that little hiccup and the improvement that we saw there in these investment grade corporate bonds seems to have vanished. So in this overview, this longer term overview, I am changing the relationship between stocks and bonds in favor of stocks, and I am avoiding, again, corporate bonds. They're not making that rotation back into the leading quadrant. So let's move to the next level on this pyramid. That is the yield curve. We're going to put the US in comparison to international markets, and we're going to look at some commodity sub-indexes. If we look at what happens on the yield curve in the fixed income market quickly, then this is the RRG that shows you the various segments of the curve beginning at 1 to 3 months all the way up to 20 plus years. And what we see here, this on the left hand side inside the improving quadrant, these are all the shorter dated maturities. So Bill, Shy and IEI are the shorter dated maturities, and they are rolling over, which means that shorter term bond prices are dropping, which means that shorter term yields are rising. And we see the opposite, sort of opposite rotation on the longer end of the curve, where we have IEF, not so much, but TLH and TLT, which are the real long-term segments of the curve, inside weakening and moving higher, which means that the yields on the longer end of the curve are dropping, which means that overall the curve is flattening. So we got on the shorter end, yields are going up. On the longer end, yields are going down. That means a flattening of the curve. And if we look at GOV in total, as we just saw, it looks like that whole thing is coming down and yields are moving up. So the yield curve is flattening and moving higher. Just for your perspective, there is a pretty cool dynamic yield curve tool on the StockCharts website, and I invite you to actually check that out. If we continue here and we have a quick look at what happens in commodities, and we're using the GSCI commodity groups here, we see that the energy tail is rolling over, but it's the only one inside the leading quadrant, and it's actually looking still pretty good. We have precious metals and industrial metals inside the weakening quadrant picking up momentum, but they are also still losing relative strength versus GNX. So I keep them at a neutral view until they actually start to curl back up and point towards that leading quadrant, or even better, curl into that leading quadrant at a positive angle. And then on the far left we have GKX, which is agriculture and livestock. So these are the underperforming sub-indexes inside the commodity space. Now, if we then move to what's happening in international markets, then we need to load up our international stock markets RRG, and if we look at that and find the US, then we see a very nice rotation here for the S&P. So we see the rotation for the S&P versus the Dow Jones Global. It had a weak stint, but it's now actually picking up quite nicely over the last few weeks. And if we put that in perspective with prices, then we're picking up here. S&P is still below the Dow Jones Global Index, but it's picking up momentum and it's starting to move into that 0 to 90 degree heading, almost, not quite, but almost. We're almost there, and we're close to crossing back into the leading quadrant, which is always a good thing. Now, if we look at other markets, then India is doing pretty good, moving over to from the improving into the leading quadrant, which is good. We have Brazil inside the leading quadrant, but losing relative strength. So we got to see whether this is temporary or a definite rollover for the Brazilian market. The level of relative strength, the ratio, is not that strong. So not a very strong move. It's still good, but not a very strong move for Brazil. And then we have China coming back into the leading quadrant, which is actually a pretty good sign. So we got, I think, India and China showing very nice tails, and then we got the S&P following. Obviously, the S&P leading markets is the market that we're interested in to put it into an international perspective. And I think that this rotation back upwards warrants an upgrade for the US market in the international space versus the other markets in the world. Quickly, Nikkei not very good. That's one that stands out immediately. I got Hong Kong, and then we got, what's this one here? Mexico. Mexico far left, moving further deeper into the lagging quadrant. So that's it for the international markets. US picking up and back to potentially one of the leading markets in the world. Now let's move over to the individual sectors inside the S&P 500. We already discussed them briefly during our overview, but here we're going to put them in a longer term perspective and see how they're doing relative wise versus the S&P 500. XLB materials inside the leading quadrant, but still strong. It's losing a little bit of relative. Let me bring that chart up for you. Losing a little bit of relative momentum, but we're still above this major resistance area, and I think from a trend perspective that's pretty good. What I'm sort of watching is this break in relative trend, this short-term one, that's causing the loss in relative momentum, and that's causing the rollover in the leading quadrant. For the time being, it's pretty good. Not sure how long that's going to last. If we go to communication services, then we see that this is inside weakening. Let me bring that up for you. Also well above its resistance, well above this all-time high, trending up further, managing to hold up well above this former resistance level in the trading range. It's losing a little bit of relative momentum because it's not pushing further up, but that could be a temporary thing. So I believe that this still is a very good sector to be invested in, or at least overweight if you compare it to other sectors in the S&P 500. If we then move to energy, that is a sector that's been very weak for a long time already, and you see that we've discussed it a few times. You see this massive move. We had this massive move on the price chart, and it remained on the left-hand side of the plot, and now you see that this momentum move seems to be coming to an end. It's rolling over. There is already a high in place in the RS ratio, and I think that's being confirmed by this rotation here. So I'm going to keep that at an underperform. It's going to come back now. And financials had a good stint, rolling over inside improving, a little bit, following the tail of the energy sector. But what I noted today, and I actually sent out a tweet about that, is that this sector, financials, is now actually breaking to new relative lows. And that's not a very good sign, especially not when your RS ratio is that far below the 100 level and your momentum is already rolling over. So I was already very careful with financials, but I'm going to be more careful now because I don't think that this is a good move for the financial sector. We go to industrials. We see that the last time we updated industrials, it was red, it was underperformed. That was about a month ago. And you see that it's now inside improving, rolling over, and we saw the good week now, and you see that rollover seems to be forming one of these wavy patterns, and it started to gain on the RS ratio scale. And if we look at that on the price chart, then you see that we are pushing against a resistance level. We managed to break above its previous high. We're in this consolidation. I'm sort of betting that this, well, at least it's not a big downtrend anymore, hence the neutral view from a sector level up from weakening. And then we have the technology sector, still far to the right. Look at that rotation. It's almost stationary. You see it there over the last 10, 15 weeks, stays there, highest RS ratio, highest ranking sector, still all good for that sector. We're going to have a look a little bit more in depth on that sector later on. Let's quickly move on to staples, consumer staples. Picking up on the momentum scale, not doing much in terms of relative strength or trend of relative strength. I'm going to keep this at a underweight, at an underperformance view, ranking, no matter, whatever you want to call it. It is breaking to new highs, so that is a positive, but we're still way down on the RS, on the relative strength versus SPY, and that keeps the RS ratio at a very low level. So despite the fact that it's breaking to new highs, there's no real acceleration, and there is certainly not a lot of relative strength versus the S&P for this sector. And that keeps it into the lagging quadrant. So it's not a bad sector, but it's just that there are many other sectors that are giving you better performance versus the S&P 500 if you want to beat the S&P 500. Now we have real estate. We already saw that. That's not doing very well. Utilities. Similar picture as staples, one of the defensive sectors. And as you can see here, it's sort of moving sideways. And look at this relative trend. That's also breaking to new relative lows. That is not a good sign from a relative perspective. But for the market, if utilities and staples, which are both super defensive sectors, are breaking to new relative lows, that means that somewhere else in this market, think communication services, think technology, think discretionary, things are going much better. So the fact that these sectors are breaking to new relative lows is probably good news for the market as a whole. It translates into a higher stock market. Healthcare is a bit disappointing. That didn't do as expected. And we see, despite it broke to a new high, but it's not doing anything. And you see the weak relative strength. Again, so this is not a bad sector. It's trading near all-time highs. It broke out. But there are other sectors that are moving much faster with rising relative strength, where the healthcare sector now has declining relative strength. And that's what put that into the lagging quadrant. And then finally we have consumer discretionary, loss of momentum. Look at the chart here, discretionary, no problem at all. A little bit loss of momentum, but you see that the RS ratio is already starting to pick up a little bit. This is just a very strong relative line. This is just a very strong chart. Yes, it's dominated by Amazon, but this is what the sector is doing. If you trade the ETF, this is what you're looking at, and this is what you get. I want to leave it at this for the sector overview and for the investment pyramid. We're going to a quick break, and we'll be back after that with a look at industries in the technology sector. And welcome back. Thank you for staying, and I hope I can make the last 5-6 minutes of the show worth your while. What I'm going to point to you is a set of indexes that's available on StockCharts that are based on the S&P industries. That's a further breakdown of the usual sector breakdown that we use most of the time, like the XLK, XLY, XLC, etc. It's a set of indexes that is characterized by a name string that has S&P 500 industry. And if you hit that in the search engine, you will find all S&P industry indexes. I think it's about almost 100 of them. which gives you the ability for a more granular breakdown of certain groups in those sectors. Now, the technology sector obviously is a very interesting sector to keep an eye on, and what I did, I filtered out the industries that make up XLK, the sector, so the information technology sector. And these are these 6 industry indexes. And that is very interesting. If you look at that, there is one group that stands out, and that is the technology, hardware, storage, and peripherals industry index. No surprise that that is the group where Apple belongs to. And clearly this now is pushing everything else to the left. There are pretty good stocks in here, but compared with this group and with Apple, they're all relatively bad. So this is the domination of that one group, and that is dominated by one single stock, Apple. If you look at how that went over time, because you can actually animate this like any other RRG, you see that it behaves pretty normal until the last few months when COVID-19 hit the markets and Corona and everything that's happening in the world, and you see that Apple starts to take off together with a lot of other mega cap stocks, and it's pushing everything down. So that XLK sector is dominated by one group, which is dominated by one stock, which makes it vulnerable. That's very clear. That technology sector is very vulnerable. If something happens to Apple, then I don't know what's going to happen with technology, and I certainly don't know what's going to happen with this group. So we've got to keep an eye on that. But I just wanted to give you the toolage and the tool set to do a deeper dive and break down this technology sector into technology industries that give you a little bit more granular view of what's happening and how that sector is built up. And of course, you can do another breakdown. You can look inside this technology hardware sector and find the individual stocks that make up that sector. And when I loaded up this group and compared it to the industry index, which is this one here, and started to play around, I thought the RRG was broken. Because look at this. If you look at this, we max it out. Now look at the rotation here. There's this one single thing, Apple. This whole RRG has a 5-week tail. Let's make it a 30-week tail, just for fun. Look at how that animates. This is a 30-week tail on Apple. This is how strong that stock has been over the last few months, since mid-2019. It's just sitting there, doing its thing, outperforming the market, outperforming the group. If we take away all these other tails, then all of a sudden we see that there is actually a tail on Apple. But because it's so far away, it's distorted, because you see that these numbers are super small. They are very close together. So if we update it just for fun again, you see this. So that is how one stock can dominate and how big the impact is. Anyway, I just wanted to give you the knowledge and point you to that group of industry indexes that we have available on the site. You got to make your own groups for that, but you can save them as bookmarks on an RRG or in chart lists or wherever you want to save them, and then it will help you probably to get a good view on how these groups are performing within the bigger sector. I think it's a helpful tool. I will start setting up my RRGs with those groups and show them to you over the course of the next couple of weeks as we dive further into each sector. Thank you for watching. Please do your thumb magic. Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern with replays on the YouTube channel.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.